check. Okay. Chalo. So are we all ready? Okay. With the next chapter, that is going to be cost of capital. Okay. So this chapter is going to be super fun. Lot of calculations. Okay. But I'll explain you this chapter conceptually. Okay. I'll revise everything one by one. Okay. Now see. Guys, whenever I'm dealing with cost of capital now, always remember that whenever we talk about the word capital, what is that word capital called as? That word capital is called as your capital employed. What is that word called as? Capital employed. And we are going to learn how to calculate the effective cost of the capital which we are employing. Okay. Now see. What are the different sources from which we can raise the capital, everyone? Can I say we can raise it by the way of equity, then debt, then preference shares, then also can I say reserves and surplus? That can also be one of the source from which we can do expansion process. Come on, yes or no? Yes, sir. Okay. Now see, always remember that whenever we are going to take into consideration your debt, whenever you are going to take into consideration your debt, okay, so that debt can be of two types. One, we call it as irredeemable debt, and second, we call it as redeemable debt. Okay. Whenever I'm talking about irredeemable debt, it means that it's a perpetual debt. Will there be any time period for the purpose of redemption of that particular debt given in the question? Come on, yes or no? Then the answer is no. So when you are required to calculate the cost of this irredeemable debt, how do you calculate the cost? So we take interest and we multiply that by 1 minus tax and we divide that by your net proceeds into 100. Okay, so that's how we calculate the cost of debt. What's the formula? Everyone please tell me. Interest into 1 minus tax upon what? Net proceeds into 100. So that is the formula on the basis of which we can calculate your KD. Okay. Now you must be wondering, sir, why do we take interest into 1 minus tax? Now interest, when we debit in the P&L account, are we going to reduce some profits? Come on, yes or no? Yes, sir. And whenever the profit are reduced, will it lead to tax savings? Come on, yes or no? Yes, sir. So that is why whenever we debit interest in the P&L account, we save your profits and hence we save your tax. We reduce your profits and that's how we save your tax. So that's why we take into consideration KD is equal to interest into 1 minus tax upon net proceeds into 100. What is the meaning of the word net proceeds? Net proceeds indicates what is the total amount of the money which will be received by the company if they issue the irredeemable debt today. Okay. Suppose the face value is 100 rupees. But if you want to issue the debt at 10% discount, then can I say my net proceeds will be how much amount? Can I say it will be 90 rupees? So will 90 rupees be taken into consideration for your net proceeds? Come on, yes or no? Yes, sir. Similarly, whatever is the market price of equity share which is given to you, what is given to you with a market price. So then we assume like this, that the new debentures will be issued at your market price. So then we take market price as your net proceeds. So net proceeds means the total amount which we are going to receive when we are going to issue the debentures, which is always your issue price minus whatever is the flotation cost. What do I mean by flotation cost? Issue expenses. Because whenever I'm going to issue some debentures, will there be any issue expenses? Come on, yes or no? Yes, sir. Because I cannot just go to the exchange and just issue my debentures like that. I have to appoint someone who will then help me out in purpose of, issue of this particular debentures. Don't you think that definitely there is going to be some flotation cost? Come on, yes or no? Yes, sir. So we have to subtract that flotation cost. And based on that, we'll be finally getting something which is called as your net proceeds. So KD is equal to what, everyone? Please tell me what's the formula? Interest into 1 minus tax upon net proceeds into 100. But if it is a redeemable debenture, whenever there is a redeemable debenture, I want the answer in one voice. Will there be any redemption terms given to you in the question? Come on, yes or no? Yes. That life of this particular debenture is 5 years. We'll be redeeming this at this particular price, premium, etc. If no information is given to you, redemption always happens at your par value. So whatever is the par value at which the redemption happens. Now in that particular case, what will be the formula for KD? So it will be interest into 1 minus tax plus RV minus NP. RV minus what? NP. NP stands for your net proceeds. We divide that by N and we divide the entire thing with what, beta? RV plus purchase price upon 2 into 100. So this is the formula which we are going to apply it for what, beta? KD. And this formula will be applicable when the debentures are dash in nature, when the debentures are redeemable in nature. Okay, so this is regarding your cost of debt. Okay, now also at the same time, okay, this is nothing but NP, net proceeds. Okay, now what if we are talking about your preference share capital? Now in preference share capital, if the preference shares are irredeemable in nature, can you please give me the formula for the KP irredeemable, everyone? Then the answer will be preference dividend. Will you save any tax? Then the answer is no, because dividend is nothing but distribution of profits. It always comes after your tax. So we will only take preference dividend and then we will divide it with what, beta? Net proceeds into 100. And what about the second part when the KP is dash in nature? Tell me what? Redeemable. Then in that particular case, your KP will be what, beta? Preference dividend plus. What are we going to do, beta? RV minus NP upon N. And we are going to divide this with what? Tell me. RV plus NP upon 2 into 100. Okay, so that is how we calculate your KP, which is going to be redeemable. So always remember that in redeemable, the only difference is instead of this interest 1 minus tax, what will come here, beta? Preference dividend. Rest all the other things are going to remain the same. Okay, then let's talk about your cost of equity. Now whenever we are talking about cost of equity, my dear students, here we have to calculate your K, and this calculation of K is always going to be very dynamic. Now we are not going to calculate K by using only one approach. Why? Because K is nothing but expectation of equity shareholders from the company. What is K, everyone? Expectation of equity shareholders from the company. See, whatever the equity shareholders are expecting, that is nothing but cost for the company. So understand a situation like this. Okay, let's say for example, I have invested in Reliance Industries Limited and I have also invested in HDFC Bank. Now, don't you think if I make investment in these two shares of the company, I will be expecting something from the company? Come on, yes or no? Yes, sir. I will be expecting, if the company is dividend distributing, I'll be expecting some dividends from the company. Achha, if the company is non-dividend distributing company, then I will expect earnings from the company. So definitely there's going to be some expectation from the company. And whatever I'm expecting from the company, that is nothing but the cost for the particular company. So my expectation is nothing but what? It is the cost for the particular company. So how do I do the calculations for the same? So my dear students, to calculate the KE, we have something which is first called as your dividend yield approach. So how do you calculate KE using dividend yield approach? So this KE is calculated very simply by taking DPS upon MPS into 100. Can you recollect this? We have done this in ratio analysis also. In ratio analysis, we did how do you calculate the return for an equity shareholder. So that return is nothing but DPS upon MPS into 100. But whatever is their return is nothing but my cost. So that's why we calculate KE by using what formula, beta? DPS upon MPS into 100. Okay. But this is only and only applicable when we know that dividend per share is going to be constant till perpetuity. When the dividend per share is going to be what, beta? Constant till perpetuity. When it is going to be constant throughout towards its perpetuity, if it is going to be constant, then the formula for K is going to be what, beta? DPS by MPS into 100. Then my dear students, we have the second part, which is also called as your earning yield approach. Can you please tell me now what's the formula for your earning yield approach? So your K will be, instead of dividend per share, we have to take what? Earning per share upon market price per share into 100. Can I say this is how also we can calculate your KE? Come on, yes or no? Yes, sir. But here also EPS is going to be constant till perpetuity. But do you think that, my dear students, DPS and EPS are going to be constant only till perpetuity? Then the answer is absolutely no. That's why, my dear students, we have something which is called as your dividend yield growth approach. What is it called? Tell me, everyone. Dividend yield growth approach. Now this dividend yield growth approach is also known as your Gordon's model. Okay. And what does Gordon tells you? That if you want to calculate your KE, you have to take D1 upon P0 into 100 plus G. So in this particular case, what is your D1? Can I say this is D1 is nothing but expected dividend at end of year 1? Come on, yes or no? Yes, sir. This is nothing but expected dividend at the end of year 1. So this is nothing but a dividend which you are going to receive at the end of year 1. Because if you buy the share today, will you get last year's dividend or will you get your next year's dividend? Next year's dividend. And then there is growth rate which is given to you in the question. Then can I say my next year dividend is going to be what? Can I say D0 and plus your growth rate? So whatever is your last year's dividend, we add the growth rate to it. Can I say we will be getting something which will be called as your D1? So yes or no? Yes, sir. Okay. And then my P0 is the same and growth rate will be given to you in the question. Okay. Now, also at the same time, if the growth rate is not given to you in the question, then there are different ways to calculate the growth rate. So one of the way to calculate, there are two important ways to calculate the growth rate. Now, one of the way to calculate the growth rate is that whenever the past dividends are given to you, what did I just say? Whenever the past dividends are given to you, then we have to take the average of the past dividends and that will give you your growth rate. Okay, so one of the way to calculate the growth rate is what? You will be having the past dividends which will be given to you. Okay, so we'll be having, let's say for example, dividends which is given to us 1, 1.1, 1.21. So in that particular case, can I say my growth rate is nothing but what? 10%. Okay, so when the past dividends are given to you, we calculate the growth rate like this. But in the second approach, they will tell you that if suppose there is a retention ratio given to you and then there is ROE given to you. So in this particular case, how will we calculate the growth rate? We will take whatever is your retention and we multiply that by ROE. So B is nothing but retention and ROE is nothing but your return on equity shareholders. So we will take your retention and we will multiply that with what? Your ROE. Will be getting your growth rate. Okay. So growth rate can also be calculated by taking retention into ROE. How much money you are retaining, that you have to multiply that by your return on equity. That's how also we can calculate the growth rate. Okay. Then also at the same time, if there is no dividend per share given to you and if it is your basic earning per share company, so in that particular case, your earning yield growth approach can be, can I say KE will be nothing but E1 upon P0 into 100 plus G. So this concept should be used under what situation? This concept should be used when can I say the company is non-dividend distributing company, but they have given to you earnings. So whatever is the earnings at the end of year 1, we divide that by P0 into 100 plus G. That's how we calculate something which is called as earning yield growth approach. Also at the same time, we can also calculate KE using your capital asset pricing model. Have you heard about CAPM approach, capital asset pricing model? Here my KE will be calculated by taking what? RF plus RM minus RF, which I need to multiply by beta. So that's how I'll be calculating my KE. So I have to take into consideration whatever is the risk-free rate plus RM minus RF. So what is this RM minus RF called as? So this is actually called as your market risk premium. What is it called as, beta? Market risk premium. And this beta is called as your sensitivity index. What is it called as? Sensitivity index. That how much, by how much times my company's share price is fluctuating when there is 1% change in my Nifty. Whenever there is 1% change in my market. So let's say for example, if my market increases by 1%. If my market increases by 1% and during that time my share increases by 2%. Can you please tell me what is going to be the beta in this particular case? 2. Okay, because it is twice. It is moving twice as compared to the market. If my market increases by 5% and if the stock increases by 10%, can you please tell me by how much times my beta is there going to be? My beta is going to be there for 2 times. So are you guys understanding that beta is nothing but your sensitivity of dash with dash? Sensitivity of stock with as compared to your market. So it's sensitivity of the stock with the market. Okay. So beta will always be given to you and that will be helpful for you to for the purpose of calculation of your KE. Okay. And then the last approach which we have is called as your realized yield approach. Now realized yield approach for the purpose of calculation of KE is very similar to your IRR concept. Okay. Where we have to find out the discounting factor at which your PV of CI is equal to your PV of CO. So basically whatever is going to be your market price of equity share, suppose that is given to you as 50 rupees. So now my under realized yield approach, what I have to do is I have to find out the discounting factor in such a way that all the future value of cash inflows gets discounted and it comes to what price? It comes to 50 rupees. Okay. So this is something which I'll teach you when I'll be doing investment decision chapter, because IRR concept comes there. Okay. At that time, we'll be discussing this part. Okay. But for the time being, I just want you all to make a comprehensive list of the approaches. So how many approaches are there to calculate the KE? So look, come on, how many approaches are there to calculate the KE? 6 approaches. Okay. Where dividends are constant, what is the formula? Dash upon dash into 100. DPS upon MPS into 100. When the dividends are not given to you, but earnings are constant. EPS upon EPS into 100. But when the dividends are growing at a constant rate, dividend yield growth approach formula D1 upon P0 into 100 plus G. And when the earnings are growing at a constant rate, what's the formula? E1 upon P0 into 100 plus G. On that basis, you can calculate. What is the CAPM formula, everyone? RF plus RM minus RF, which we multiplied by beta. And then when it comes to realized yield approach, we are going to calculate that using what? Trial and error method on the basis of IRR. Okay, on that basis, we'll be calculating it. And if growth is not given to you, but if you have to calculate the growth rate, how many ways are there to calculate the growth rate? 2 ways. What's the first way? When past year our dividends are given and they are growing at a constant rate, so that will be taken as your growth rate. And when, my dear students, we have retention ratio given to an ROE given to you, can I say growth rate will be nothing but retention into ROE. So this is how we calculate the cost of your equity. Now what about your cost of reserves and surplus? Can I say reserves and surplus is also nothing but the profits which is available for equity shareholders? Can that also be used for the purpose of expansion and growth? Come on, yes or no? Yes, sir. Suppose I have generated some profits of 1 lakh, but I decide I don't want to distribute any profits. So can I say I am retaining those profits? Now if I'm retaining those profits and if I'm doing expansion and growth, will that be money free of cost or will it cost you something? It will definitely cost you something, right? So that reserves and surplus also bears some cost. Come on, yes or no? Yes, sir. It is also going to bear some cost. So that is why we call it this as your KR. What we call it as beta? KR. But please tell me, reserves and surplus is whose money, beta? Equity shareholders' money. So that's why your cost of reserve and surplus should ideally be your cost of equity only. Your reserves and surplus cost and your cost of equity both should actually be the same only. But if both the things are not the same, then there are certain situations in which your KR and KE are not going to be the same. Okay, I'll explain you what. But first of all, are you all agreeing with the concept that reserves and surplus belongs to whom? Equity shareholder. So whatever you calculate your cost of equity, can you apply that to your reserves and surplus also? Come on, yes or no? Yes, sir. But KR is not equal to KE when there are two important situations. Now, what are the two situations in which KR is not equal to KE? One of the situations when KR is not equal to KE is when there is flotation cost given to you in the question. What is given to you? When flotation cost is given in the question. So guys, to calculate your KE, what do? You take D1 upon net proceeds into 100 plus G, because whenever there's flotation cost, don't you think, my dear students, you have to compulsory subtract from the market price per share whatever is the flotation cost? Come on, yaar. From the market price per share, can I subtract flotation cost? Come on, yes or no? Yes, sir. So from the market price, if I subtract flotation cost, what do I actually get? I get something which is called as my net proceeds. Okay. So one of the way to calculate this is what? D1 upon net proceeds into 100 and market price, I subtract flotation cost, I will be getting something which is called as net proceeds. Do you agree with this? Okay. But my dear students, you also have to understand that when we are calculating KR na, there is no need for adjusting the flotation cost, because whenever we are issuing new shares, at that time flotation cost will come. But whenever there are old shares, will there be any flotation cost or there will not be any flotation cost? There will not be any flotation cost. So in that particular case, your KR will continue as D1 upon P0 into 100 plus G. So in this particular case, can I say this will be the formula for KR? But for KE, you will be using this formula. So can I say KR will not be equal to KE? Come on, yes or no? Yes, sir. Similarly, my dear students, when there is shareholders personal tax given to you, when what is given to you? Shareholders personal tax. So in that particular case, whenever you are calculating KR, that will be nothing but KE into 1 minus tax rate. Now, what is the meaning of this shareholder's personal tax? See, understand a situation like this. If you are an equity shareholder, I am the company, and I tell you that I am not going to distribute the dividends. I will keep it with me. Okay. So definitely you will be expecting something from that reserves and surplus. Okay. Your expectation is my cost. Okay. Now on equity shares, you are already expecting, example, 10% rate. So you are expecting 10% rate. Okay. Now when the shareholder's personal income tax is given to you now, then your KR and KE will not be the same. Now why? If this dividend would have been distributed to you, that income you will invest somewhere else, and on that income, whatever tax you are going to pay, don't you think that that tax I have to subtract it while calculation of my KR? See, because let's say for example, if I give you 100 rupees, that 100 rupees you will invest somewhere else. You will earn 10% on it. So you will be earning 10 rupees on it. But on that 10 rupees, don't you think you will pay tax to the government? So in that particular case, if 30% is the tax rate, so your KR will become how much percentage? 7%. So now on that reserves and surplus, which I have kept it with me, in that particular case, I will only want to earn how much percentage? 7%. Because has it this particular dividend, if it would have been distributed to you, you would have invested somewhere else, earned 10% and paid tax on it. So that is why your post-tax return on that distribution would have been just 7%. But if this money, if I am keeping with me, and if I am retaining that, then that particular funds will bear a cost of how much percent? 7%. So that is only and only applicable when what is given to you? Shareholders' personal tax. But if shareholders' personal tax is not given to you, can I say my KR and KE, they both are not going to be the same? Come on, yes or no? If shareholders' personal tax is not given to you, then KR and KE both are going to be the same. Yes or no? Yes, sir. Okay. So this is something which we are going to discuss, in your, next particular chapter. But this is how you calculate all the specific types of costs. Okay. Now, let's say for example, if I tell you that, if I want to calculate the total cost. Okay. So if I want to calculate, let's say for example, if my company has debt, equity, preferences, everything in it. Okay. And if I tell you that we are required to calculate the total cost. So that total cost is called as your what, beta? It is called as your KO. How is it determined, beta? With the help of what? KO, overall cost of capital. Now, suppose my debt amount invested is 1 lakh. My equity amount is 50,000. And my preference shares is, let's say for example, 3,50,000. Can you please give me what's the total amount which is invested? Come on, first 5 lakhs. Now, what is going to be the weights in this particular case? So this will be 1 lakh divided by 5 lakhs. So that will be what? 20%. This will be what? 10%. And this will be what? 70%. The total has to be 1. Now, if I want to calculate the overall cost of capital, that is KO, can I say I need cost of debt, cost of equity, and cost of preferences? And all this KD, KE, KP, how will we calculate? What I explained in the first part. On that basis, I gave you the formulas, right? Based on that formulas, you can calculate KD, KE, and KP. And once you get KD, KE, and KP, what will you do? You will multiply that by the weights and calculate the overall cost of capital. So that will give you your Q. Okay, so what will be your KO, beta? We are going to take into consideration whatever is your KD, KE, KP. We'll substitute that. We have the weights. So ultimately, we'll be getting your weighted average cost of capital. Okay, this is nothing but weighted average cost of capital. That is your Q. Okay, now this weighted average cost of capital or Q can be calculated in 3 ways. So the first thing which is known as is called as your book value weights. What is it called as? Tell me. Book value weights. So here, the second thing which is called as your market value weights. And the last thing which is called as is known as your marginal value weights. So how many types of weights are there, beta? 3 types. The first one is what? Book value weights. This book value weights are also known as your balance sheet value weights. What are they known as, beta? Balance sheet value. So what is balance sheet value? Whatever are the figures which are there on the balance sheets now, liability side, like equity share capital, like debt, like preference shares, we have to take directly those values only in the amount column, and that's how we'll be calculating the weights. So the figure in the amount column will directly come from where? Directly will come from where? It will directly come from your balance sheet. But whenever I'm talking about market value weights, then all these instruments which are there, I will multiply that with what, beta? Market price per share. So I am going to multiply this with what? Market price per share. So I want debt ka what is the market value? That will be taken as the weights. Equity, I want market value. Preferences, I want the market value. But let's say, for example, we are talking about long-term loans. Will loans have any market value? Then the answer is no. So then in that particular case, can I say my book value itself will become what? Your market value. And then we have something which is called as marginal value weights. This marginal value weights are known as what? Additional value weights. It means that marginal means additional, right? Margin. Okay, so how much extra funds which I am raising, what is the cost of that? That is something which is called as marginal value weights. So are we concerned with book value and market value in that particular case? No, we are not concerned with that. We are just only concerned with what, beta? What is the marginal value? What is going to be the extra amount which we are going to raise, and what is going to be the cost of that? So that is something which we are going to take into consideration in your marginal value weights. Are you guys okay with this? Okay. So how many types of weights are there? Everyone, solo. 3 types. First, second, third. Marginal value weights. Okay. Book value are also known as what? Balance sheet values. Directly figures will come from your balance sheet. Come on. In market value weights, directly the figures will come from your market prices. Okay. And in certain cases, if the market price is not available, then dash is equal to dash. My book value itself is going to be my market value. And what is the third type of weights, guys? Marginal value. Marginal value is also known as your what? Additional value. So we are just going to be concerned with how much is going to be the extra amount which I am raising and what is going to be the cost for the same. Okay. Are you guys okay with this much? Okay. But now also at the same time, my dear students, remember that whenever we are dealing with market value weights now, their reserves and surplus will not come. So will reserves and surplus come in your market value weights, or it will not come in your market value weights? It will not come. So why will reserves and surplus not come in your market value weights? Because when I am taking equity shares market price, don't you think that market price of equity share is always after considering the impact of what? Reserves and surplus. So that's why reserves and surplus usually should not come in market value weight. I'll give you an example. Let's say, for example, your equity share capital is 1 lakh, okay, and RIL has reserves and surplus of 3 lakhs. Can you please give me what's the total equity shareholder funds? Come on. 1 lakh is your equity share capital and this is reserves and surplus. Give me equity shareholder funds. Solo yaar. 4 lakhs. This is nothing but your equity shareholder funds. When I talk about Bhavin Industries Limited, suppose equity share capital is 1 lakh, but reserves and surplus is 9 lakhs. Can you please give me your equity shareholders funds? 10 lakhs. Everyone, please tell me now in one voice, don't you think that Bhavin Industries Limited has a higher equity shareholder funds? Which company will have a higher market price? RIL or BIL? Which company will have a higher market price? BIL will have a higher market price because there is more equity shareholder funds also in that particular case. So when BIL will have a higher market price, please tell me everyone that market price in BIL will be higher. And why is it higher? Can I say because the impact of reserves and surplus. So in market value weights, are we going to consider reserves and surplus, or we are not going to consider reserves and surplus? We will not consider reserves and surplus. Why? Because equity share market value is after only taking into consideration the impact of reserves and surplus. But there is an exception to it. Whenever your K is not equal to KR, what did I just say? Whenever the K is not equal to KR, in that particular situation, can I say reserves and surplus should also be coming in the market value weight? Someone, yes or no? Yes, sir. Because now K is not equal to KR. So we have to do the bifurcation of that market value of equity, which I'll explain this to you. Okay. So in market value weights, for the timing, always remember that reserves and surplus will come or it will not come. Come on. It will come or it will not come. It will not come with only one exception. When K is not equal to KR, will reserves and surplus come? Come on, yes or no? Yes, sir. Okay, because you have to bifurcate it. Or else market value of equity is always after considering the impact of reserves and surplus. In marginal value weights, all the types of funds will come. Come on, yes or no? Yes, sir. KE, KD, KP, KR, everything will come. Okay. So this is how we are going to calculate your book value, market value weights, and marginal value weights. Okay. So in the entire chapter, we are going to do this only. Okay. So I want every one of you to now. So how many formulas have I taught you? How many formulas have I taught you? If you all can recollect, my KD had how many formulas? 2. My KP had how many formulas? 2. Now my KE has how many formulas? 6 approaches, right? 5 plus 1. But this one approach is what? IRR approach. Not to be done now, right? And then I also taught you how do you calculate your KR. And when I'm talking about KR, can I say my KR is always equal to KE? But how many exceptions are there when KR is not equal to KE? 2 exceptions. One, when there is flotation cost, KR is not equal to KE. And when there is shareholders' personal income tax, at that particular case, KR is not equal to KE. So in this particular case, we will take KE into 1 minus tax. And here, instead of dividing it by net proceeds, we will always divide that by market price of equity share. Come on, yaar. Okay, have you all understood this? Okay. Now, based on this, let us start with your illustrations first. So let's get started. What is given to you in your illustration 1? Are you all ready? Okay. Students who are sitting on Zoom, can you see the slide properly? I hope there is no problem in viewing this particular. You can see it properly now. Whatever notes etc. I'm writing, can you see it properly, beta? Zoom students, any problem here? Okay, no, perfect, superb, thank you. Okay, great. Okay, so now let us start with your very first question. Okay. 5 years ago, Sona issued 12% debentures which are irredeemable at rupees 103. Okay. So guys, can I put it like this, that we had issued that at 5 years ago, what was your issue price? 103. Okay. At a premium of 3 to the par value of 100. The current market price of this debentures is rupees 94. So can I say we have the current market price? What is the market price right now? It is nothing but what? Rupees 94. If the company pays a corporate tax rate of 35%, if the tax rate is 35%, calculate the current cost of debenture capital. So we are required to calculate current cost. It means cost as on today, not cost 5 years ago. If we are required to calculate current cost, that is cost as on today, so should we divide that by issue price or should we divide that by the market price? Market price, obviously, because we want to calculate the cost today. Okay. Please tell me, is the life given to you in the question? Solo, is the life given to you in the question that in how many number of years we are going to redeem this particular debentures? Is the life given to you? Come on. If the life is not given to you, are we going to use redeemable or irredeemable? Irredeemable. What's going to be the formula for KD? Everyone. Interest into what? 1 minus tax upon what? Net proceeds into 100. What's my face value, guys? 100. What's my rate of interest, guys? 12%. So can I say this will be 12 into 1 minus, what's your tax rate? 35. And I will be dividing that by the net proceeds. So what is my net proceeds? The market price, 94 into 100. Will this give me my final answer? Come on, yes or no? Yes, sir. So that will turn out to be what? 8.3%. First illustration, absolutely clear, guys. Okay. Now let us start with the second part. Okay. Now see, in illustration 2, what is given to you? Okay. A company issued 10,000 10% debentures of rupees 100 each at a premium of 10% on 1st of April 2023, which is to be matured on 1st of April 2028. Do we have life available? Come on, yes or no? So to 1st April 2023 to 1st April 2028, what is the life beta? 5 years. 23, 24, 25, 26, 27. But 27, 28. So that is why we are taking into consideration 5 years. So the first year you have to actually take like this. 23, 24, that's the first year. So 23, 24, 24, 25, 25, 26, 26, 27 and 27, 28. Okay, so till 31st March 2028. So that is how 5 years will be taken into consideration. Okay, and you are required to calculate what should be your cost of debentures assuming 35% tax rate. Guys, is this the formula? Interest into 1 minus tax plus RV minus NP upon N upon RV plus NP upon 2 into 100. Now the face value is 100. What is the rate? 10%. So can I say interest will be 10 into 1 minus tax rate? What is my redemption value, guys? Solo, redemption value. If no data is given to you, we will redeem everything at dash. Par. So par will be nothing but 100. Okay. And what is my net proceeds? My net proceeds is, am I issuing some debentures at a premium? Come on, yes or no? And what's the premium beta? 10%. So please tell me now, what is going to be my issue price, net proceeds? Can I say it will be 110, right? So that is how I got this net proceeds also as 110. I just have to substitute this. I'll be getting the value which is 4.2%. Absolute clear, guys? Okay, super. Have you understood this? This is your illustration 2. Let's talk about your illustration 3. A company issued 10,000, 10% debenture of 100 at par on 1st of April to be matured on 1st of 28. The company wants to know the cost of its existing debentures on what date? 1st of April 2023. So are we concerned now with 1st of April date, or we are concerned from 1st of April 2023? 1st of April 2023, what is the maturity time period, beta? 1st of April 2028. Okay. So we had issued the debentures on what date? 1st April 2018. Today is what date? 1st April 2023. And this is getting redeemed on what date? 31st of March 2028. 1st April 2028 is nothing but 31st March 2028, right? So in this particular case, we are standing here. So should we consider this as the remaining life? Come on, yes or no? Yes, sir. What's the market price of the debenture? 80. We are required to calculate the company's cost of debentures. Okay. So we have current market price as 80. We have interest on the face value. Redemption is 100. Life is 5 years. Tax rate is 35%. We can calculate that and we can get the KD, which is nothing but 11.67%. Okay. This YTM concept, I want to explain this, but I will explain this to you after we take into consideration your investment decisions, and that is your capital budgeting will take into consideration. After that, we'll be discussing this illustration. Okay. Or else, are you guys aware about it? Are you guys aware about what is discounting? So I can do this right now only. We can go in the sequence only. Are you aware about what is discounting factor and present value terms and etc. Right? So let's do this together only. About what is this yield to maturity, I'll explain this to you. Okay, so let's do this together. Now, how do you calculate your cost of debentures when using your YTM approach? Okay, so now pay attention. Okay, I'll give you an example. You will understand this with the help of the example only. See, suppose my debentures whose face value is rupees 100. Life is, let's say, for example, 3 years. Redemption value is, let's say, 110 rupees. Okay, redemption value is 110. And suppose your interest rate is nothing but 10%. Okay, this is nothing but your coupon rate, right? This is your coupon rate. And the tax rate which is given to you, that is 30%. Now, if I ask you what is the cost of the debt, if I ask you what is the cost of the debt, under normal approach, which is also called as approximate method, how can you calculate KD? You can calculate interest by taking face value of 100, coupon rate is 10%. What's your interest? 10. 1 minus, what's the tax rate? 30. What's the life? What's the redemption value? 110. Minus what? Net proceeds is 100. Come on here. Okay, we are issuing this at par, at 100. What's the life, beta? 3 years. Okay, and this I will divide it with what? Can I say 110 plus 100 upon 2? Come on here. So based on this, can I calculate my KD? Okay, calculate. Give me the KD. Give me the KD. What's the answer? Just check. Is this the answer? Okay. So everyone should get the answer as what? 9.84%. So are you all getting the KD which is coming at 9.84%? Solu, yaar, yes or no? Okay. So this is 9.84%. That's your KD. Anyone else having any other answer? No, you're getting the same 9.84%. So this is one of the method. Now what happens under YTM approach is that we take into consideration year 1, 2, 3. What is going to be the series of cash flows? Okay. So can I say interest and redemption value? This is going to be the series of cash flows. Now interest is what? 10 and your tax rate is 30%. So can I say my interest will now become what? 7. So for the period of 3 years, the company is going to pay interest of 10 on which 30% will be your tax rate. So can I say that 7 will be your cash flows, which will be taken into consideration? Yes or no? Yes, sir. For an investor, 10 rupees is nothing but the return. On that, 30% tax is paid. So can I say 7 rupees is going to be nothing but the inflow? Come on, yes or no? Yes, sir. Now, at the same time, at the end of the third year, I want to redeem this. So I will redeem this at what price? The redemption value is given to you as 110. So all these are nothing but my what? Series of cash flows. Now this series of cash flows, I have to discount it at some particular percentage in such a way that my present value here should be the market price per share. So what's the market price per share? At what price am I issuing this? What's my issue price, everyone? Can I say I've decided this to issue this at what price? At what price? 100 rupees. So in that particular case, I want the market price to be what, beta? 100. So I have to discount all these things at a particular percentage in such a way that my market price continues to be what? 100 rupees. So how am I going to do this? So I will first take the discounting factor of, let's say for example, let me take a discounting factor of 9%. If I'm taking a discounting factor of 9%, can I say this will be 1 divided by 1.09? So my first PV factor will be 0.9174. Come on here. My second PV factor will become what? 0.8417. Third one will become what? 0.7722. I hope you all know how to do this, right? So on that basis, I can get the present value 7 into 0.9174. So this will give you what? 6.4218. If I take 7 and if I multiply that by 0.8417, this will give me what? 5.8919. And if I take 117 and multiply that by 0.7722, so this will give me what? 90.3474. What is the total which is coming as? Can I say this is coming as 102.66? Is this greater than 100 rupees? Come on, yeah. Is this greater than 100 rupees? So can I put it like this, that 9% is not my YTM, because I want the YTM in such a way that both the things should be same. So 9% is not my YTM. So now I will try to discount it at what percent? Let me try it at 10% and calculate the present value. So now I'll be calculating at what percentage? 10%. So everyone with me, 1 divided by 1.1. So this will give me what? 0.9091. This will give me what? 0.8264. And this will give me what? 0.7513. Okay. So now in this particular case, what is going to be my present value? 0.9091 into 7. Then 0.8264 into 7. And then 0.7513 into 117. So this price is coming as what? Again, it is slightly coming as 100.05. Okay. Can I put it like this? Still, my YTM is not achieved. Why? Because I want the price to be what? 100. So it will be slightly more than 10%. Are you guys trying to understand? Or else if we round it off, then can I say my YTM is coming as how much percentage approximately? Can I say it's coming as 10%? Here my answer was 9.84. Here my answer is 10%. But are you understanding that there will be slight error in the answer? Why? Because here we are just taking up to how many decimals? 4 decimals. So we are not taking all the decimals into consideration. So that is why it is possible that your answer will not exactly match. But YTM can be calculated like this. Now let's say for example, if instead of 100, my issue price is, my issue price is coming as, let's say 101. So that's my issue price. So can I say that my YTM is somewhere between dash and dash? Can I say it's between 9 and 10%? Because at 9%, you all can just check what's the market price per share. 102.66. At 10%, what's the answer which is coming? 100. Okay. But I want at what price, at what rate, this should be 101. So can I say now it is somewhere between 9 and 10%? Come on, yes or no? Yes, sir. So now I have to use dash. Interpolation. What is it called, beta? Interpolation, to now calculate what should be your YTM. So now to calculate the interpolation, we have to use one method. Now what is that method? See, this is 102.66. Suppose, let's say for example, the issue price is 101. Okay. Now please tell me, from 102.66, I should reach what? 101. So can I say I just have to discount 1.66, right? But between 9 and 10%, how much am I discounting? I am discounting 2.66. So by increasing 1% rate, my present value is getting reduced by how much amount? 2.66. But I don't want to reduce up to 2.66. I just want to reduce up to 1.66. So based on this, how much percentage will come? So 1.66 divide that by 2.66. So this is coming as what? 0.62%. So this 0.62% I have to add to my base, that is 9%. So ultimately I'll be getting this as 9.62%. Okay, this is your interpolation. So in interpolation, we always create a range. Okay, this will come in your capital budgeting. This will come in your investment decisions when I will be doing IRR. So in IRR, again, I'll explain you this concept. But for the timing, you have to understand that we have to prepare a dash. What do we have to prepare? Range. Where one PV of CI will be greater than the required PV of CO, and one PV of CI will be less than the required PV of CO. So we will come to know that your IRR is between this 2%. It's between 9 and 10%. So it is more than 9 but less than 10. So 9 and 10, are we enhancing your discounting factor by how much percentage? 1%. With that 1% increase, just check how much rupees I have brought down. 102.66 to 100. So then I brought down 2.66. But from 102.66, I don't have to go to 100. I have to just go to my issue price, which is 101. So then in that particular case, from 102.66, if I just want to go to 101, so further for 1.66, how much discounting I need to do? So you cross multiply, you'll be getting this as 0.62%, and that's how you'll be getting 9.62%. So this is something which you're going to get with the help of dash. You'll get by the way of your YTM using interpolation. Okay. Are you guys understanding this? So this is your YTM. Okay. Which is very similar to your IRR method. Okay. Now, this is what even they have told you how to do it by using IRR calculation. They have given some examples. Okay. But before that, let us solve this particular question and this illustration 4. See what is given to you. Institutional Development Bank issued 0 coupon deep discount bonds of the face value 1 lakh, each issued at 2,500, repayable after 25 years. Now first, let me just revise what is the basic meaning of deep discount bonds. Have you heard about zero coupon bonds? Zero coupon bonds. Zero coupon bonds means what? Coupon means interest. So zero coupon means zero interest bonds. So what is the basic meaning of zero interest bonds? Will the company every year provide you with any interest? No. So why will people invest in such kind of bonds? Because these bonds now, they are issued at a discount and they are redeemed at a par. So they are issued at what? Discount, and they are redeemed at what? Par. So every year you will not get any interest, but you will get the redemption value towards the end. So let's say, for example, I am the company and I want some money for 10 years. I want the money for many number of years? 10 years. So you know what will I do? I will issue you the bonds, 1 lakh rupees. Okay, face value is what? 1 lakh. But I will issue this at 60,000 rupees. I will issue this particular bonds at some discount. At what price am I issuing it, guys? 60,000. So you are all going to purchase this bonds at what price? 60. At the time of redemption, how much money will I give you? 1 lakh. So don't you think you are going to get 40,000 rupees profit? But in this 10 years, will you get any interest? No, you are not going to get any interest. So now we are learning how do you calculate the yield of these kind of deep discount bonds or zero coupon bonds, where there is no interest given to you every year. But there is only one way of earning from this kind of bonds, and that is nothing but dash minus dash. Face value minus issue price. Redemption value minus issue price. That will be nothing but the profits which will be earned by the bondholder. Are you guys understanding this? Okay. So just check this out here. They have told you that the bonds which is having redemption value of 1 lakh, what's the net proceeds? 2,500. Okay, so this is nothing but the issue price, 2,500. And what's the life? 25 years. Now, as you all are aware, do you know how do you calculate the yield? You calculate a yield by taking amount is equal to principal into 1 plus I raised to the power n. Come on here. If I want to know what's my I should know amount. Amount is nothing but the money which will be received after 25 years. What is P? P is nothing but your principal. Amount invested today, 2,500. And 1 plus, what is I? We have to find out that and raise to the power 25. So now if you take this 1 lakh and if you divide that by 2,500, will this be coming as 40? So 40 is nothing but 1 plus I raised to the power 25. Okay. So this is nothing but your 40. Now you have to calculate your dash. You have to calculate your interest rate. Now you must be wondering, sir, how can I take root of 25? So then in that particular 25 times the root, you cannot take it on your normal calc. It's not going to be possible. So they will always give you this PVIF in the examination. This value will always be given to you. That what is the rate at which this becomes 40. Okay. So you can calculate that by using your tables, okay, which is given to you behind, or else they will always give you that R is available at 15%. Can you just check at 15%? This figure is coming as 32.919. So what is your, FEIF which is given to you? So this is nothing but future value interest factor. This will be given to you. So they have told you that at your 15% rate, this value is available as 32.919. What is this value, beta? 32.919. And at 16% rate, this value from the table only you will get it. That is 40 point, how much? 874. Okay. So at 15%, can you just check? Achha, you all have this with you right now in the study module. You all can just check. It is there with you. Okay. If you want, I'll just open this for you. See, it's there now. Perfect. See, exactly this table only. At 15%, what is the life? 25 years, na? Just check this. Can you just check? This is the FEIF table I was talking about. FEIF. Okay. So in this FEIF table, which is there in the appendix, everyone can just open this table. FEIF table. Can you open up that? Okay. Now see this FEIF. Okay. What is first of all your life? Your life is what? 25. Okay. Now see, you want 40 rupees. What do you want, beta? You want 40. Now to get 40, just check in the table, where is this 40 coming? Okay, so I'm checking 40. For 25 years, first of all, I need to check. Can you just check for 25 years? This is the life, right? So 40 is coming in this particular row. Where is it coming? Can I say it's coming here? 32.919 and 40.874. So do you have the rates here available, which is 15 and 16%? Come on, yaar. So in this particular case, can I put it like this? That at 15% my rate is 32.919. At 16% my rate is 40.874. Is my interest rate somewhere between 15 and 16? Can I use interpolation? Solo. Can I use interpolation? Now interpolation 15% plus something. Please tell me between 15 and 16, what's the gap? What's the gap between 15 and 16? Tell me. In 1%, what's this gap? Can I say it's nothing but 32.919 minus 40.874? What's the gap? Just check. The gap is 7.955. So the gap is 7.955. But from 30.919, I just want to go to what? 40. So now just check 30.919. If I subtract 40 to it, then what is this value? 7.081. So on this, what is going to be the balance? What is going to be the final answer? So if you just take this is coming as 0.89. So you take 0.89 and finally the answer will be 15.89. So you don't have to increase your factor from 15 to 16%. You just have to go from 15 to 15.89 and you will be getting that 40. So that's your interest rate, which is nothing but 15.89%. Are you guys understanding this? Okay. So with the help of these tables, you will be able to get it. Okay. Sure. Great. Now next, let us talk about this amortization of the bond. Okay. Now, what do you mean by amortization of a bond? Please tell me, what is the basic meaning of the word amortization? What is amortization? Can I say amortization is nothing but when we are redeeming, redemption of the bond, right? But here we are not redeeming it at one particular point of time. We are redeeming that over the number of years. Okay, so that is called as amortization over the number of years. Okay, so let's say for example, if your bond is having a face value of, in this question, 5,000, and how much number of bond, what is the life of the bond? 5 years. So every year, how much amount will be amortized? 1,000. Amortized means how much amount will be given back to the bondholder. So every year, how much amount is given back to the bondholder? 1,000 is the amount which is given back to the bondholder. Okay. So in this particular case, they have told you that the bond will be amortized equally over the life. Calculate the bond's present value if he expects a minimum rate of return of 6%. So here the rate is given to you. What is the rate given to you? 6%. Now we have to calculate the value of the bond. Now, if I have a future cash inflows available, and if I discount it, can I say I can get the present value of the bond today? Come on, yes or no? Yes, sir. What is the value of the bond today? Let's say, for example, capital budgeting, investment decision. In investment decision, what you were doing? Whatever was the cash inflows you were receiving, you were discounting that, you were getting the present value of the cash inflow. I am asking you this. In investment decision, you will have studied this, right? If I tell you that there is a particular project whose life is 5 years. And if I ask you that, calculate present value of the project, how will you calculate it? You will write down what is going to be the list of the cash inflows. Suppose the cash inflows is 1,000, 2,000, 500, 5,000, 1,000. What do you do with this cash flows? We discount it at some particular percentage. What do you get, beta? We get your present value. Come on here. You all know this. In investment decision, we do this. We take the cash inflows, we discount it, we get the present value. But here your investment is not in the project. Here your investment is there now. Where is it? Bond. And if I want to calculate value of the bond, then don't you think every year I should check what is the cash inflows which I am receiving? Arey, come on, yaar. What do I have to check every year? What I'm going to receive? Cash inflows from the particular bond, right? So if I want to find out the value of the bond today, how do I find out the value of the bond today? I will estimate what is going to be the cash inflows which will be generated from the bond. I will discount it and I will bring it to what? Present value terms. Will I be getting the value of the bond today? Come on, yes or no? Yes, sir. So see, if your investment decision concepts are not clear now, then after a complete investment decision, again revisit this question. So you'll find it in much better way. But it's very easy to understand. If we are investing in a project, we get the cash inflows, we discount it, we get the present value. Similarly, now if you are investing in bonds, can I say if you are going to invest in bonds, what will we get? Can I say we'll be getting your interest? We'll also be getting some redemption value. What do we need to do with the same beta? We have to discount it and we have to bring it to what? Present value terms. Will that give you your value of the bond? Come on, yes or no? Yes, sir. Are you guys understanding this? Okay. So I am having cash inflows, and this cash inflows, my dear students, will be now in the form of the principal amount as well as the interest. Okay. Now please tell me that every year how much amount of principal amount you are going to get. Now, if the bond is 5,000 and it is going to be redeemed over the period of 5 years, can you please tell me every year how much are you going to get? Every year, can I say the cash flow will be 1,000? Solo yaar, every year it will be 1,000. Okay. But don't you think that also at the same time you will be getting some interest also? Now, how will you calculate the interest? Can I say the bond has 5,000 rupees and the rate of interest is what? 8%. So in the very first year, you had entire 5,000 rupees with you. So can I say my interest will be what? 400? Because on 5,000, you'll be getting the interest at the rate of 8%, that is going to be 400. In the next year, what is going to happen? Can I say from 5,000, 1,000 rupees is given back. So interest will be calculated on what? 4,000. Because company has told you that from this 5,000 rupees, I have already given you back 1,000. So how much money is there with me? 4,000. On that 4,000, how much percentage interest will be there? 8%. So that will be what? 320. Then in the third year, from this 4,000, how much money is gone? 1,000 rupees is given back. So how much is remaining? 3,000. You multiply that by 8%. What is the interest here going to be? 240. Can you please give me now what is going to be the interest for the fourth year? Give me the interest for the fourth year. 160. Because now it is what? Only 2,000. And in the last year, what is going to be the interest? 80 rupees. Because we only have 1,000 rupees left with us. So when the company has only 1,000 rupees left with you, can I say on 1,000 only 8% interest that will come, that is 80 rupees. So are these going to be your series of cash inflows? And now this total cash inflows, I can discount it at what is the investor expecting? 6% rate. Can I say I'll be getting the present value, and this present value is nothing but the value of the bond. Understood this? So how do you calculate the value of the bond? So all these series of cash flows, just check 1,400, 1,300, etc. If you discount it at 6% rate, finally you'll be getting this cost, which is 5262. Okay. And in investment decision, what we used to do, the same concept we are doing here. The only difference is here the cash inflows are in the form from which we are receiving from the bonds. And in investment decision, we are receiving it from the cash inflows from the project. Here we are receiving it from the bond by the way of amortization and by the way of interest. So that's how you find out the value of the bond. Understood this? Okay. Okay. So I'm just assuming that you all are aware about what investment decision concepts are. That's what I asked you earlier also. Okay. But usually I always teach this after I teach investment decisions. Okay. These 4-5 questions. But now I think it's very much comfortable. Okay. You can find out the value. Okay. Now continuing further, let us now start with the cost of convertible debentures. Okay. Can you all please tell me what is convertible debentures? There is no question for the same. But basically, what is convertible debentures? Can I say convertible debentures is nothing but, how much the debentures, how much is the value of the equity shares you are going to get once you convert the debentures into equity shares. Okay. See, let's say for example, I'll tell you something like this. The market price of equity share is at present 20 rupees. What is the market price of equity share, everyone? Market price per equity share is 20 rupees. Okay. And now also at the same time, please tell me for one bond, you are going to get 10 equity shares. So if you convert one bond, how much number of equity shares you are going to get? 10 equity shares. Can you all please tell me if the market price of equity share is 20 rupees? So can you all please tell me what is going to be your conversion value? Can I say for one bond, you are going to get how much? For one bond, how many equity shares you are going to get? 10 equity shares. So if I convert the bond into equity shares, do you know what is the meaning of converting the bond into equity shares? I'll go to the company and I'll tell the company, listen, I am giving you bond, you please give me 10 equity shares. So when the company is going to give you 10 equity shares, then in that particular case, what's the market price of an equity share? 20. So for every one bond, if you're going to get 20 equity or 10 equity shares and the market price is 20 rupees, what is your conversion value? 200. Last bench, you're not paying attention. Okay, this is very simple, beta. See, suppose you have one phone with you and I tell you that you give me one phone, I'll give you two phones. Okay, and suppose my one phone value is 5,000 rupees. So in that particular case, if you give me one phone, I'll give you two phones. What is the conversion value which you have got? 10,000. So that is nothing but 5,000 into two phones. Come on, yaar. So same thing happens with the equity shares also, yaar. Can I say whatever is the market price of equity share, you multiply that by number of equity shares. Can I say you'll be getting nothing but something which is called as your conversion value? Solo, yes or no? Yes, sir. You'll be getting the conversion value. But it all depends when the conversion is happening. Whether the conversion is happening today or when the conversion is happening after some number of years. Suppose if I tell you that market price today is 20 and the conversion is happening at the end of the third year. When is the conversion happening? Tell me. At the end of the third year. So now to calculate the conversion value, will I take this market price or will I take market price at the end of the third year? I will take the market price at the end of the third year. Now how will I calculate the market price at the end of the third year? Based on what is the data given to you in the question. Suppose they give you in the question, for example, they give you that this is the price at which it is going to grow. They will give you some growth rate. Then we have to add the growth rate to it. See, just check this example 3. Okay. A company issued 10,000 15% convertible debentures of rupees 100 each with a maturity period of 5 years. And at maturity, the debenture holders will have an option to convert the debentures into equity shares of the company in the ratio of 1:10. Okay, now just check when is the conversion going to happen? Now or at the end of the 5th year? Come on, answer this. Now or at the end of the 5th year? At the end of the 5th year. So my conversion is going to happen at the end of the 5th year. Now they have told you what's the current market price. Just check what's the current market price of equity shares. So look, what's the current market price of the equity share? 12 rupees. Right? 12 rupees now. So now will the conversion value be at the end of the 5th year? Will the market price be 12 rupees only? It will be lower or it will be higher? Higher, because they have told you the growth rate is given to you as what? 5%. So can I say here the market price will be 12 into 1 plus what's the growth rate? 5%. 0.05 raised to the power 5. Or else if you want, simply take 12 plus 5 plus 5 plus 5% plus 5% plus 5% plus 5%. You will be getting the same answer. Okay. So take 1.05 square cube 4 5 multiply that by 12. What is this value which is coming as? Rupees 15.32. Just check. Is this the price? 15.32. And then how many shares we are going to get? 10 shares. So what is going to be the conversion value? 153.2. Can you just check the conversion values? 153. Whew. Have you understood this? Okay. Everyone clear? Okay. So this is regarding your convertible. Okay. Then there is illustration 6. Okay. So let's do this illustration 6. See guys, what is given to you? XYZ and company issues 2000, 10% preference share of rupees 100 each at rupees 95. We are required to calculate what is the cost of the preference shares. Guys, is there any life given to you? Is the life given to you? Come on, yaar. So now if the life is not given to you, is this redeemable or this is irredeemable? So if it is irredeemable, how will you calculate your KP? You will take preference dividend, which is nothing but 10% of 100. Can I say that is 10 rupees? Divide that by what? 95. Multiply that by 100. This is 10.53%. Okay. Illustration 7. If our energy is issuing preferred stock of 100 with a stated dividend of 12 and flotation cost of 3%, calculate the cost. Now when there is flotation cost which is given to you, everyone in one voice, what is going to be your net proceeds? Is it going to be 100 only or it's going to be 100 minus flotation cost? Right, so 100 minus flotation cost. So can I say your net proceeds is going to be what? 97. So you take 12 divided by 97, you'll be getting this as 12.37. Okay. Come to illustration 8. Now in illustration 8, just check. What is given to you that XYZ issues 2000, 10% preference share of 10 each at rupees 95 and the company proposes to what? Redeem the debentures, redeem the preference shares at the end of the 10th year from the following date of issue. We are required to calculate the cost of preference shares. Now this is irredeemable or redeemable, but redeemable. This can be done directly only. We have RV, NP, etc. Everything we can do it. Okay. This is illustration 8. Now let us talk about KE. KE also I explained you all these approaches. Come to illustration 9. Now what is given to you? A company has paid a dividend of rupee 1 per share. Can I say this is nothing but D0? Hello. This is dividend per share, which is nothing but D0. Last year and is expected to grow at 10%. Calculate the cost of equity if the market price is 55. Can I say there is a single growth rate which is given to you and the dividends are growing at a constant rate of what percentage? 10%. Can you please give me what's KE formula? D1 upon P0 into 100 plus G. What was the last dividend? 1. What's the growth rate? 10%. What's your P0? 55. Into 100 plus 10%. Can you give me the answer? This is 1 plus 10%. That is 1.1. Divide by 55 into 100. That will be 2%. So this is 2% plus 10. That will be 12%. Because whenever you multiply 100, it's a percent, right? So it is 2% plus 10. That will give you your 12%. Superb. Everyone's okay with this? Okay. And then this is your realized yield approach, which I was talking about. Okay. Let us do this particular illustration 10. Now what is given to you? Mr. Mera has purchased a share of Alpha for rupees 1000. Please tell me, is this nothing but your purchase price? Come on, yes or no? So you have purchased this for 1000. He received a dividend for a period of 5 years at the rate of 10%. So now he has received 10%. So that is why your face value is nothing but 1000 only. No data is given to you. What's the face value? 1000. And the dividend they have told you is nothing but at the rate of what? 10%. So every year you will be getting 100. At the end of the 5th year, he sold the share for 128. We are required to calculate the cost of equity as per realized yield approach. Please tell me, my dear students, what is the series of cash flows which you are going to get? First of all, please tell me what is the life of your investment. What's the life of your investment? So can I say for the period of 5 years, will I start receiving some cash flows? I'm asking you, will you receive some cash flows? Yes, sir. And that will be nothing but your dividends and at the end of the 5th year, your market price per share. You are selling it. So what is going to be the market price per share? Every year, how much dividend you are getting, beta? 100 is the dividend which you are getting. 100, 100, 100, 100. And now at the end of the 5th year also 100. Plus we are selling the share. So there will be some cash inflow. How much is that? 1128. So what is this going to be? Total 1228, right? Now, what is the price at which you are buying? Read the first line. They have told you the price at which you are buying. At what price are you buying? 1000 rupees. Now I have to discount it at such a rate that I should get here 1000. I should discount it at such a rate that here the price should be what, beta? It should be 1000. Okay. But have they given you any discounting factor? No. So we will take first 10%. And we will check whether the price is coming 1000 or not. Okay. Can you please all give me the present value here? Okay. Give me the present value here at 10% rate. I want every one of you to solve this. Give me the price here. This should be 1079.48. This should be your answer. Correct? Now please tell me if this is 107.48, is it greater than 1000? Is my target achieved or my target is not achieved? Not achieved. So what will I do? I will discount it at what rate? Should I enhance the discounting factor? Right? So I will enhance it and I'll keep it at 15%. Let me check at 15%. So now if you must be wondering, sir, why not 13 or 12 or 14? You can take any particular percentage. But in trial and error method, we will take it at 15% and we will check what is the discounting which is coming at 15%. Okay. So can you now give me what is going to be the answer at 15% rate? So you should all be getting this as 896.03. Hello. Present value 896.03. Everyone should get this as 896.03. Barabar? Everyone got this? Okay. Now please tell me, is this less than 1000? Now have I got a range? Have I got a range? Yes or no? Yes, sir. So it is more than 10, but less than 15. Because I am spending 1000 rupees. So one PV of CI is 1079.48, which is greater than 1000. And one is less. So can I say I've already got a range? Come on, yes or no? Yes, sir. So it is what, beta? It is more than 10, but less than 15. So what am I going to do? Now can I say I will be using interpolation? So I will be using interpolation. So what is interpolation method, guys? Can I say between 10 and 15, what is the gap? How much is the gap between 10 and 15? 5% is the gap. And in this 5% gap, how much am I discounting? 1079.48 minus 896.03. What is my gap, guys? 1079.48 minus 896.03. The gap is of 183.45. Right? 183.45. But I don't want to go from 1079 to 896. I just wanted to go from 1079.48 to how much? 1000. So we just have to discount 79.48. So what is going to be the answer here? 79.48 into 5, divide that by 183.45. So this will give you what? 2.17. So this is now going to be 2.17. So finally it's going to be 12.17. This is your yield as per realized yield approach. 12.17%. And just check in the question, they have told you they have done directly at 12%. That's how it's getting 1000. But you will never know. You will have to create a range. And this 0.5% gap plus minus will always be there, because on the basis of which we are taking the calculation. Now, how on earth will someone know that we have to directly do it by 12%? So we have to definitely take a range and then we have to do it. Okay? Super. Everyone understood this? So they have told you, see, they have referred to trial and error method. Now, how can they be so accurate at 12%? So we have to create a range and then we have to find out at what particular percentage we have to do it. Okay? Chalo. Now, let's do question number 11. Okay? Are you guys ready? Now, what is given to you? Calculate the cost of equity from the following data using realized yield approach. So your, my dear students, they have told you your 1, 2, 3, 4, 5, and you also have 1 rupee, 1 rupee, 1.2, 1.25, 1.15. Now in this particular case, they have told you, see, if you read this, price per share at beginning. Now how do you interpret this? Can I say this 9 is nothing but P0? At the beginning of year 1 is nothing but P0. When I tell you it is the beginning of first year, it means today. So that is why this is nothing but P0. But dividends you will always receive at the end of year 1. Okay, so this is nothing but D1. Are you understanding? This is D2. This is D3. This is D4. And this is D5. And this is P0, P1, P2, P3, and P4. Are you understanding this? Because they have told you that this is the price at the beginning. Okay. Now you are required to calculate what should be your yield. You have to calculate what should be your, final answer. What should be your realized yield approach. Now in this particular case, my dear students, as you guys can just check, we have the price at the end of which year. The last price which we have, that is the price at the beginning of the 4th year. Right? Now, in this particular case, if I want to calculate my yield, I have to create a series of cash flows. So I will take year 1, year 2, year 3, year 4 and year 4. Because I only have the price at the end of the 4th year. So now I will only take the series of cash flows from year 1 to year 4. Because if I take year 5 also, do I have price at the end of 5th year? Do I have the price at the end of the 5th year? So I only have the price at the end of which year? At the end of the 4th year. So this is year 1, year 2, year 3, 4 and year 4 only. Okay, because ultimately when I will sell the share at the end of the 4th year, I should know what is the cash inflow which I am receiving. So that is something at the end of the 4th year. And now I will at the same time take dividend per share and market price per share. Can you give me dividend per share for year 1? 1. For year 2? 1. For year 3? 1.2. For year 4? 1.25. Okay. And what's the market price at the end of year 4? 10.6. Okay. Now I need to discount all these things in such a way that my present value should actually be what? 9. Because what is the current market price, beta? Can I say the current market price today itself is 9 rupees? So this is your current market price. Just like the previous question, what was the current market price, beta? 1000. Solo, yaar. The current market price was 1000 and we were selling the shares at the end of the 5th year in which 1128 was given to you. But here I don't have the price at the end of the 5th year. But do I have the price at the end of the 4th year? Come on, yes or no? Yes, sir. Are you guys trying to understand this? Okay. So that's why we will take year 1, 2, 3, 4, 4. Okay. And today's price is nothing but 9 rupees. So I have to discount it in such a way that I should be getting what? 9 rupees. So I will now take the discounting factor. Now, what is the discounting factor which I will take? Let us take a discounting factor of, let's say, 10%. And do this. Chalo, everyone give me what should be the final answer. See, this is 10.6 plus 1.25. So this will give me 11.85. Okay. Now let us discount this at 10%. Are you getting the same? Just check. What is the PV which I'm getting, beta? 10.73 only. Okay. Can I say now this 10.73 is not my final answer? Because this 10.73 is what? Greater than 9. But actually I want this to be what? Less than 9. Are you trying to understand this? So here I will try to discount that now. Let's try at 15% and let us check whether at 50% we are getting the answer or not. Oh, again at 15% I'm not getting. It's coming as 9.19. It should be coming as 9.19. So now I still want 9. What will I do? I will discount it now at what percentage? Can I take 16%? Because now by 1%, so definitely I'll get it here. So let me discount it at 16% and calculate the present value. This is called as real trial and error. Not the one what ICAI directly gives you. Okay, so this is now at 15%, it is 9.19. And at 16%, now if you calculate at 16%, this will now be 1 divided by 1.16. $8.91. Yeah, 8.92. Is this what you are getting? 8.92. Now please tell me, here it is less than 9. Come on, yes or no? Yes, sir. So now at 15%, guys, now just check. At 15%, what was it? 9.19. At 16%, what is it? 8.92. So don't you think now it is between 15 and 16%? Can I do interpolation and get it? Come on, yes or no? Yes, sir. So you want to try interpolation one more time? Just do it. It is 15% plus something. So just check what's the difference between 1%. In 1% difference, we are taking from 9.19 to 8.92. So that is 0.27. But I just want to go to 0.19. So this should be how much? So this will now be 0.19. Divide that by 0.27. So this is 0.7. So my final answer is coming as 15.7%. Their answer might be 15 point something or 15. Their answer is 15. But it depends upon what is the series of cash inflows which you are taking. What are the discounting factors which you are taking? We are doing it on that basis. If you ask me whatever we have solved is correct in the examination, 1000% it is correct. Okay. So you can absolutely do it in that particular way and get it. Okay. Chalo. Now CAPM approach, we have to now come to illustration number 12. Now calculate the cost of equity of H Limited where the risk-free rate of return is 10% and the firm's beta is 1.75 and the return on the market portfolio is equal to 15%. Now we are required to calculate your KE. How will you calculate KE, guys? RF plus RM minus RF into beta. Hello? What's your risk-free rate? 10%. What's your RM, guys? What's the return on market portfolio? 15%. So you'll take 15% minus 10% and what's your beta? 1.75. Can we get the answer? 5 into 1.75 plus 10. So that will be eventually 18.75%. Superb. Then we have cost of retained earnings. And now I want you all to come to question number illustration 13. Face value of the share of the company is what? 10 rupees when the current market price is 200. Company is going to start with a new project and is planning to partially issue new shares and partially by retained earnings. You are required to calculate cost of equity and cost of retained earnings if the issue price will be 190 and the flotation cost will be 5 and the dividend at the end of the first year is expected to be 10 and the growth rate is 5%. Now whenever they give you dividend at the end of year 1 is nothing but 10 rupees, my first simple question to you is, do we have to add growth rate to the dividends or already D1 is given? Already D1 is given to you. Come on, yes or no? Yes, sir. So now I have to calculate first my KE. If I want to calculate KE, I will calculate. So what's my D1? So look, come on, 10. What's my issue price? 190. And what's the flotation cost? 5. So can you please give me what's my net proceeds? Come on, yaar. 185 So this will be 185 into 100 plus what's the growth rate? 5%. Is this data sufficient for you to calculate this? Come on, yaar. So this will be nothing but what? 10.40 or 10.41%. But my dear students, when I'm talking about KR calculation, what did I tell you? Now in this particular question, is KE is equal to KR? I'm asking you, no. Can I say my KR will be nothing but it will be calculated without flotation cost and without whatever is the issue expenses. What is the market price? 200. So I have to take only directly 200. Got it? Okay, so this is the difference between KR and KE. What we have just now discussed exactly gets proved here. Okay. Illustration 14. ABC provides the following data. What's the D0? 4.19. This is 50 and this is growth rate 5%. Calculate cost of retained earnings. So we have D0 4.19. We add a growth rate. We divide that by 50. We'll be getting the answer. Not worth it. Okay, same. Now ABC provides the following details: RF, beta and RM minus RF. We are required to calculate cost of retained earnings based on CAPA model. So we already have RM minus RF, that is 6. Multiply that by beta, add the RF, we'll be getting this answer. Come on, yaar. Okay. Then there is weighted average cost of capital. Okay, but before we start with weighted average cost of capital, we'll just take a small break. After that, we'll continue further. Okay, relax.